My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to help you save some money. My job is not just to put it in context and entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. After the worst day since the crash of '87, second worst day ever, with the Dow plunging nearly 3,000 points to the lowest close in 2 years. S&P plummeting 11.98%, NASDAQ nosediving 12.32%. A truly sickening day with a horrendous last hour. It's finally dawning on people that we're in a real crisis here. I've been telling you that this pandemic could be real bad news for stocks since I came back from that Super Bowl chasing that we were underestimating the coming outbreak that could send us into a, well, I want to say a recession, because I think that it's pretty obvious that, well, that's kind of where we're going. You know, the people did underestimate the coming outbreak, and I've got to tell you that as far as I'm concerned, it really isn't one of these situations where we can just kind of ride it out. We have to think about it. We got to figure out what to do. We got to work together. And I've got some ideas. They're not simple ideas. They're ideas involving opportunity. They're ideas involving what I regard as being, let's just say, some things that happen that are good when the market goes down. But we're not ready yet. Now, first, let's talk about what went wrong here. I mean, I've been saying that we were going to underestimate this situation. I told you that this market was headed back to lows we made the last time we were on the eve of recession, the December of 2018. We've now taken out those lows, and we can go lower because this is worse than the Fed-mandated slowdown we had back then. The market is furiously trying to adjust to the vast economic downturn that is the only way to beat COVID. And we're adjusting. We're not there yet. The averages likely won't bottom until more people adjust to the new normal that I've been warning you about for weeks. But, and this is a big but, at this point, after the dramatic heart-stopping sell-off, maybe we got to start thinking maybe it's too late to sell unless we get a sharp squeeze. Remember, that was a short squeeze that we had on Friday. Yeah, but these levels, when everyone's cashing in their chips in total panic and furious redemptions, you need to start considering what to buy when the bad COVID and economic numbers come out in the next few weeks. And they're going to be bad. And look, I think one of the things that really drove the market down was when the president's talking about July. People were really saying, hey, this is great, it lasts forever. It may not do that, or it may anticipate July. So we got to be ready. So then you'd probably say, well, Jim, you sound more constructive than you sound. I mean, the market's so horrible. Well, I'm a little more constructive because unlike the last big recession, this time I find that the people in charge, the real policymakers, actually understand that something needs to be done. See, in 2007, the Fed and the White House were asleep at the wheel, totally unwilling to lift a finger to stop the oncoming disaster. This time it's different. Hey, whether you love Trump or hate him, it's not about him. I think that people want to make it about him. I'm going to take another tack. I think it's about the professionals. People like Fed Chief Jerome Powell, whom I've been critical of, but he can make more of a difference than anyone in the White House when it comes to the economy. What do I mean? All right, first, yesterday I derived a degree of comfort from the actions of the Fed chief that everyone seemed to poo-poo and make fun of today. I mean, give me a break. They were loving all the other stuff he was doing that I didn't like. This I liked. The Fed made some historic moves last night, and those moves worked. We knew they worked. Why? Because your bank opened for business this morning. And let me tell you something. It probably wouldn't have. All day I heard that Jerome Powell's emergency rate cuts and liquidity injections somehow failed because the stock market got obliterated. Are you kidding me? Hey, what he did was good. He wasn't trying to save the stock market for heaven's sake. He was trying to prevent bank runs, trying to make the Treasury market work. Believe me, they were going to happen. If the Fed had done this in 2007, we wouldn't have had the worst downturn since the Great Depression. Powell took another financial crisis off the table, thank heavens. There will be plenty of losses. There'll be tons of bankruptcies and ballooning unemployment. But because Powell's got his eyes on the prize, providing liquidity where it's needed, we have one less horrible thing to worry about, and that's a big horrible. Second, this morning I spoke to Treasury Secretary Steve Mnuchin about his plans to stabilize not the markets, but the small business base of this country. Again, people think he wants to stabilize stocks. That's not what the game's about. I want to stabilize stocks. I can't. Nobody can. But he liked what the Fed did, and he made that point that labeling something a recession doesn't really advance the ball. I like that. I mentioned that what we really have is a hiatus in business. Hopefully we'll have so much stimulus that at some point Wall Street will be able to look through the current weakness and start embracing companies with great balance sheets that can thrive when the hiatus is over or when the numbers level off. Because remember, we're trying to flatten the curve. I know it's too early for all that stuff. We've taken out the lows from December 2018, but this panic is much worse than that panic because this time there will be huge layoffs and bankruptcies. That never got to it last time because the Fed changed its view. Hopefully, though, Secretary Mnuchin and Speaker Pelosi can agree to a giant stimulus package that will tide working people over until we contain the virus. And by the way, could someone understand, the payroll tax deduction? That's great if you have a job, not if you're 1099 and not if you don't have a job. So they got to think a little bigger down there. Wish I were down there, just knock some heads together. We get this thing straightened out. Put it all together, and I think there are real opportunities developing over. What is this, like Bernie Sanders here? Developing out there with the averages down 30% from the highs. The VIX fear gauge, highest level ever. Worst day since 87. A day that felt a lot like today when I traded it. So, yes, there are opportunities here, but they're narrow, and you won't be able to catch them using broad index funds. This is a time to pick individual winners and losers. Yet 60% of stocks are owned via some sort of index fund. For years, we've been told we're morons for trying to pick stocks, and the best you can do is hope to mirror the performance of broader averages. But the problem with the index funds is that you inevitably own both the winners and losers, and the difference between winners and losers has become too stark for that to make any sense. That's where the opportunity comes in, people. There are many industries that are truly on the ropes here, and I expect them to remain on the ropes for a long time, unless they fall flat on the canvas. If you invest in an S&P 500 index fund, you have to own the bad, the very bad, the disastrous, and a small group of easy to identify winners. Why own all the losers? I don't want to own any of the airline stocks because this feels a lot like the aftermath of 9/11 when nobody wanted to fly and the industry was crippled. Sure, they eventually bounced back, but only after a $15 billion bailout. We're only on maybe day 3 of what's looking like a total collapse in air travel. Don't try to be a hero there, regardless of whether the president stands behind them 100%. I don't want to own anything in aerospace either. Not with Boeing struggling, debt being downgraded. That's a bad one. That's like 2007. I know. Wish it weren't so. Oil's another problem. Economic activity's drying up, and Saudi Arabia and Russia are flooding the world with supply. You don't want to own any of the oils here. Too soon for a bounce back. You just hope that they don't bleed into all the other parts of the finance world. Same goes for restaurants, entertainment. I just got word from New York City that we have to close our restaurant and our bar. Too many people gathering. I wish! Social distancing makes this whole group uninvestable. Penn National Gaming's the paradigm. They did this great hookup with Barstool for sports betting, but now everything's canceled and there's nothing to bet on. The stock was at $39 last month. It's at $8 today. Someone upgraded Las Vegas Sands today. Really? Retail, same problem. Nobody feels like buying anything unless they're ordering from Amazon. That will change, though. I think there will soon be so much excess inventory that the off-price houses will be able to offer cash-strapped consumers some truly incredible deals. But we're not there yet, and for the moment, the whole industry is toxic. Consider Macy's has now fallen 75%, Sports at 22.5% yield, Kohl's is down 74%, 14% yield, Nordstrom's off 63%, 9% yield, nearly. Those stocks are all screaming that the earnings are in danger and the dividends will have to be cut. Retail's a disaster with the exception of the largest companies. I know the banks are cheap. And now that the Fed's taking action, I believe they'll come out whole, given that the Fed's willing to throw money at them. But until other people start agreeing with me, they'll be so-so investments at best. More likely fodder for the bears before the bottom. No, it's not 2009 when many of these banks were in single digits. However, they lost their principal support when they pledged to stop buying back stock. Let that sink in. Autos, oh, please. Auto parts, no. Suppliers, no. Commodity chemicals, no. Paper, no. Steel, no. You think maybe I'm too bearish? I don't know. Well, let's listen to Jim Fitterling, the excellent CEO of Dow Chemical, later in the show. Tech, too hard. Hey, probably too soon. Although I said last week, buying the fastest growing techs is often the best way to play a spring-loaded rebound. But you have to be prepared to lose money before we get there. And I bet you 99% of you aren't willing to, and you better start learning how to do it. With all these sectors that are too tough to own, if the data's just going to get worse, and it is, and we're going to see the denominator get big, all that other stuff, it's like, geez, it's like algebra. Why am I telling you to be opportunistic? Okay, did you know that the makers of literally everything you might find in the supermarkets saw their stocks drop in unison this morning? They got hammered because they're part of the indices. Then the stock pickers came in, the packaged food companies rallied furiously on the ugliest day and ages, and so many of the drug stocks did. While they gave back their gains in the late afternoon, some of them closed up big. I like Conagra. I know, needle in a haystack, but come on, we look for needles. What do we do here? Okay, I think we're going to get some big coronavirus numbers now that we're really going to test people's strength in earnest. We're going to get more lockdowns like in San Francisco where you may not even be able to shop, although I think grocery stores will still be open. We'll hear horrendous reports from every part of the country because we underestimated how bad it was going to be. But, well, some of us did. But today gave us a template for what works when the economy's on hiatus. The stocks of companies that make products we can't live without. Check out your medicine cabinet. Check your refrigerator. Look at your pantry. Bottom line, on a horrific day where the averages were down 12 to 13%, we got to stop buying average. Instead, we should buy quality recession-proof stocks because that's what works when the economy's on hiatus. Time to hold your nose and buy a couple of winners. Get started. As for the losers, I say no more selling. No more selling without a big up day like we had on Friday to get you better prices than you can expect into the teeth of this panic. Let's go to Jay in Ohio, please, Jay.
Booyah, Jim. How's it going?
Well, Jay, I've had slightly better days, but, I'm still around. How about you?
I'm doing well, thank you.
Good.
Hey, I got a quick question for you. Interested in adding silver or gold into my portfolio, trying to diversify up my investments. Just wanted to get your thoughts about the precious metal market right now and which is the best way to invest in coins.
Well, people have given up on the precious metals because they think that we're in a terrible deflationary storm. And I say, you know what? I always find room for gold. I think that you want to own gold, and I don't mind that gold is going down. I think you buy some right into this weakness. I actually think that Barrick Gold bottomed, and that's the way I would do it, is buy GOLD. All right, guys, you don't need, it's a brutal tape, right? Stick to the quality recession-proof stocks as they come down. This is what you have to buy into those openings when we're frozen, down 7%. That's what worked. It'll work again. On Mad tonight, America's capacity to detect the coronavirus will get a big bump from Thermo Fisher after it received an emergency okay to produce up to 5 million test kits a week. I've got the exclusive with the CEO. Then the head of CBS Health met with Trump last week to discuss the ways to combat the coronavirus. I'm going to talk about the company's latest initiatives. And in the teeth of demand-crushing global pandemic, how is a company like Dow positioning itself? I'm talking with the CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.